Good morning and welcome to MarketCast 35. My profuse apologies. We are a couple of minutes late. We've been hit by some gremlins this morning. The tech just refuses to work. So it might just be that during the next 30 minutes, you lose vision. We'll carry on. Should be able to see this screen and you should be able to hear me speak. But the proper video obviously will go up on YouTube later on this evening. And it's a very, very important market cast too. I make no apologies whatsoever for the shirt. I hope you like the bananas. This is my last throw of the dice. I'm just refusing to let summer go without just one last short sleeve shirt. The production team here, when they saw this shirt, said they thought it was very appealing. Okay, have a think about that. You'll be laughing on the way home. All right, a quick recap then. When we were talking last month about what was going on and the budget that was coming up, and Rachel from Accounts had just proclaimed that the budget wasn't going to happen till November 26. But we all knew that she was viewing the property market as a source of those funds that she so desperately needs. We know that she can't raise income tax or VAT or national insurance for employees. So where else is the money going to come from? And we thought the property was going to be low-hanging fruit. And of course, have a little look at the Zoopla numbers that actually came out earlier this week, which seems to prove the point that I made last month when I said the budget paralysis was set in, because there are so many potential options that she might use to attack the property market for tax income and tax revenue, that we're seeing this going on here. These are Zoopla numbers from Monday, and you can see here that this is the new listings. And you can see new listings priced under 500k, just a little bit up, 0.2% up, minus 4% for priced over 500k. And this is demand and new listings. Sorry, this side is demand, minus 11% for priced over $1 million. So it looks like that's happening. And of course, Rachel from Accounts has appeared at the Labour Party conference. And don't be put off by that sort of air of conviviality that she has when she's talking to the delegates at the conference. She means business and she needs the cash, and we are in the crosshairs. No question about that. So, and that's what's really important about this morning's market cast, is this is where it takes us. So we sit now while prospective buyers and prospective sellers eye up the possibility of what might happen in the budget, and I'm going to explore what those options might be before the end of this market cast. For me, you can say budget paralysis or you can say a window of opportunity. I hope that at the end of this 30-minute market cast, I am going to leave you thinking it is the latter rather than the former. This is one of those rare moments where the new homes industry has an opportunity to go steal market share from the second-hand market. They come along very, very rarely indeed. But this is one moment when we can do absolutely just that. As you know, I've forecast this year that new homes market share of the overall market will be around 10% on spec build. I think there's an opportunity for it to be higher than that this year. Let's go through in the normal way. We'll take a little look at all the key data behind the facts, and then we'll just explore some of the options that we have to turn that budget paralysis into a window of opportunity. So we know, set for November 26th, the budget, the rumours of the tax changes are rife. I'll cover those in details later on. We've seen completions take a little tick back in August. They're still around 65,000. That's the normal sort of rate for August. But we can sense that there is everywhere. If you look at all of the major indices, they can see this budget paralysis sitting out there at the moment. I think we might struggle to get to the 1.2 million. I'm stuck with volume of 1.2 million transactions this year, right from last December. I'm starting to worry about that a little bit at the moment. And I know certainly for all the developers that watch this market cast, selling out across an average of around about half a sale per live site per week just isn't working. We need to grab additional market share. The nationwide index, which came out on Monday, took an unexpected uptick. Unbelievable. But that, as I'll demonstrate to you in a moment or two, Doesn't help you if you are building south of the Midlands, because most of that uptick has been in the north, the northwest, and in Northern Ireland. And of course, the way the algorithm is written, we've got an average price that shows an uptick. But actually for the south, for the outer metropolitan counties and for the South Midlands, that's actually not helping at all. And those prices haven't moved, or even possibly have come back a little bit too. We'd look at that as well. Consumer confidence are starting to waver again, heading down towards new lows, pending the, or following rather, the announcement of the budget date and concerns that people have about what's coming. Inflation sticks at 3.8%. That's not dreadful news, by the way. And crucially, the owner occupier housing costs, the OOH costs, fell again, down to 5.3%. So they are fully 1.5% lower than where they were just a few months ago. So that underlying inflation, that really bad inflation number for the key people that the developers need to target, continues to come down, which has got to be good news. We know that the interest rates were held the same in September. And with government long-term borrowing costs being at their highest since the 80s, well, then the prospect of those coming down anytime soon starts to diminish. But we'll see. Let's take a look at some of these things in detail. The inflation numbers, the next set of inflation numbers don't come out until October 22. And we know also as well, of course, that we're not going to see the next MPC decision till the following month. But if we look at how inflation was when it came out last month, and look at the August numbers, and you can see here that this took a tiny little, took a dip down. It stayed the same, the CPI at 3.8%, but the OOH carried on coming down, a tiny little dip down from 5.5 to 5.3%. This is a really important number for us. It got right up here, and now here we are right down here, and that continues to fall. And I believe, I always say when I do MarketCast, I'm no economist, and I stick to that, but I believe that we will continue to see that fall. And I think the bank believes that too. We actually had one of the MPC members come out publicly last week and say that further cuts were required. When they start speaking to the press like that, you've got to have a sense and a feeling that they are being authorized to do that. It's almost like a little flag they're waving to see how the markets will react. Well, we'll see, won't we? But the inflation picture is not all bad news, that's for sure. The actual meeting of the MPC takes place on November 6th. So we'll get the news then. I think I'm going to sort of hedge my bets here. I think that's that's almost a 50-50 chance of a rate cut. And if somebody actually insisted I made a call, I'm going to say that November 6th we'll see a 25-point rate cut. There's lots to happen in between then and now. And of course, it's going to be the last MPC meeting before the budget on November 26th. But I think that it's more likely that we'll see a 25-point rate cut than not. Well, we'll see, won't we? You heard it here. You heard it here first. As things currently stand, these are where the rate cuts have been, and we've seen there that the rate cuts actually started back here a year ago, just over a year ago. August 24, we were at 5.25%, and here we are now sitting at 4%. The September meeting, as we know, kept that there. I think we'll see that come down to 3.75% in November. We will see. Only time will tell. As far as the interest rates concerned that are out there generally, well, these continue to gently ease their way down, certainly from where we were here in the early part of the year, where we saw quite a significant downward trend among the lenders. That has now eased. And although there is serious competition at the moment out there, because of the reduced volumes, of course, there's serious competition out there by the lenders to try and lend money, which is driving rates down. They're not coming down anything like at the rate that we expected them to at the start of the year. Another reason, by the way, it's a classic thing where prospective buyers actually use the thought in their, or that delaying thought in their head, well, hang on, if I wait for a while, interest rates are coming down, I'll be able to get a cheaper rate fixed term mortgage. Not necessarily true. And you know, certainty today is worth so much more than the uncertainty tomorrow. The bird in the hand principle. That's a really important principle to keep in mind, by the way, for the end of this presentation deck in a moment or two. But you can see where we are now, and you can see that a 2-year 90% loan to value mortgage, you can still get rates well under 5%. The average rates is under 5% as at the end of August. And I think your 4.5%-ish, that's not difficult to find right now. And I'm sure your IFAs would advise you the same. Okay, so in terms of where we go next, consumer confidence is such, I know I make a big fuss about this during the MarketCast every time that we present it, but it is so very, very important. And you can see that from the announcement of the budget date here, this data, by the way, was collected in the first 2 weeks of September. So this is just after the date for the budget was announced and just after the rumour mill started working about what taxes that, well, they just made it very, very clear that the government is going to come back with a great big scoop for more of our money. And the only question is where on earth were they going to actually set the first spade in the ground? And this has affected confidence right across the piece. Very, very quickly then, it's 2,000 people GfK asked in this survey. It's been running for over 50 years. Same thing. How are things going to be 12 months from where we are now? Are they going to be better or worse? If they're going to be better, that's a positive number. That's above this line. If they're going to be worse, it's going to be a negative number. So if the majority say things are going to be worse, the line will be below here. If the majority say they're going to be better, they'll be above there. And the red line there is the overall index score, how confidence generally is in the economy. And I'm going to jump forward a slide and jump back one. Have a look. It's amazing. So these are, excuse me, these are the countrywide estate agency members, deals done at asking price or better. Okay. There they are. That's the profile going all the way back to 2022. That's the profile. That's where we are. Now let me hop back to consumer confidence, and you can see how the shape of this chart here absolutely mirrors the way the shape of that deal's done at consumer price, at asking price or better. So it is enormously important. If you take this line and you shove it back 6 months on that next slide, it fits almost perfectly because it drives behaviors, and that obviously drives values and volumes, of course, as well. And you can see it took another dip down in September after the announcement of the budget. The blue line here, how is the UK economy going to do over the next 12 months? Better or worse? Well, you can see we've got a huge majority of people in this survey that think it is going to do worse, not better. The green line here is the next 12 months a good time or a bad time to make a major purchase, a house or a kitchen or a car, and that also took a dip down. And these now are coming back to approaching the sort of lows that were in place in September 2022 after the Liz Truss quasi-Kwarteng budget extravaganza. And the only measure that has stayed incredibly resilient is how do you think your own personal finances are going to fare over the next 12 months? And here's an interesting question for you. Ask yourself that question. How do you feel your personal finances are going to fare over the next 12 months? Yet you may feel that the economy is flatlining and you may feel it's a dreadful time to go buy a new car. And yet there is that resilience there that says, personally, I think I'm going to do okay over the next 12 months. That's very important for us. So getting back then to that slide that we were talking about, the property mark slide, the at or asking price or better. The new numbers on this are literally due out any day. I did have a look last night to see if I could give you new numbers. But as at July, which is this last one here, you can see it's quite extraordinary to think 20% of deals, that's 1 in 5 deals is not being discounted from asking price. I find that interesting just on its own. Strange, but true. Nationwide numbers came out on Monday and shocked us all, didn't they? Because I was expecting this to drop, the annual number to drop from 2.1. I'd forecast that was going to drop down to about 1.7, 1.8. When in actual fact, it upticked to 2.2. And the culprit can be seen in this chart here. So these are annual house price growth numbers for southern and northern England. So that line for southern and northern England nationwide takes through the Midlands. And here's the northern England number. Look at this here, which is actually sitting at over 4%. And here's the southern England number in blue, which is coming down here close to 0. And I believe that in some parts of southern England, it's actually in negative right now. You'll all be feeling it. You know exactly what the situation is in the sales offices out there all across the UK. So that average number, it's the classic average guy. You know, you stick his feet in the freezer and his head in the oven, and is he on average comfortable? It's that classic old cliche again, isn't it? So on average, prices across the UK are going up by 2.2%, but we know in reality it is not working like that right now. But they are the nationwide numbers, and that's fact. You know, that's their algorithm. That's certainly the latest numbers that we've got to deal with. I'm just clicking that forward. Come on then, come on. You're going to go forward? No, okay, thanks. It's there we go. The tech is running ragged with us this morning. So the house price index, Rightmove house price index, did show a little rise in new seller asking prices as we came into September, just 0.4% below the average for that time of year, what we expected. And asking prices have just started to, they've come under pressure this year, and they're just starting to show that weakness. If you look at the Rightmove, what they call their executive summary in here, you can see here now that they're talking here about the immediate budget, the concern of people, of the tax changes that are going to happen in the autumn budget, and it risks slowing down parts of the market that are already underperforming. This is exactly what we were saying earlier, particularly because of this rumour of the tax being applied, property tax being applied to property worth £500,000 or more. So nothing surprising there. Being the end of September, it means that we finally get the second quarter of the regional numbers from nationwide, and this shows you exactly what I was talking about just now, the real picture here. So these are the average change in house prices for the year to the end of September. The third quarter, here's Northern Ireland, almost 10% higher than they were at this time last year, at this time last year. Here's the north, almost 5% higher. And then as you head south, you can see how that starts to dip. And then when you get to the outer metropolitan counties, the old home counties in old money, if you like, the southwest London and the outer southeast, you've got virtually no growth whatsoever. So we have got a two-tier market going on right now, and we need to be acutely aware of that wherever you're trading. When you look at the cities index from Zoopla, which I always find really interesting, because when it comes to forecasting or doing a land appraisal, you're looking at numbers that are hugely different. So if you take Belfast at the top, they're plus 8%, and dear old Bournemouth, which is where I am standing at this very moment as I speak to you, down the bottom there at minus 1.7%. Relegation to the Championship beckons. No, we're doing very well in the Premiership at the moment, but not quite as well as the mighty Eagles. But we'll leave that off to one side. The Zoopla index itself also came out this week. So these are brand new numbers from Monday. And you can see now that they've got their annual price change sitting at 1.4%. And of course, they published that really useful data showing how the budget paralysis has got hold of the market of 500k and upwards, and particularly got hold of the market at £1 million and upwards, while the market at the lower end continues. It's just growing very, very slightly. So that's something obviously that we have to keep in mind. If we look at their classic demand and sales chart, a chart now which has become part of my regular monthly digest to keep a finger on the overall background, the macro picture if you like, buyer demand now is virtually flatlined. We've seen that higher than last year, pretty much all the way through the year, but now we've got it at 0.3% buyer demand, just higher, so pretty much flatline. And finally, the flow of new supply is now lower than where it was at this time last year. Proof positive that people are sitting on their hands in these brand new numbers. Slightly higher stock of homes for sale this time last year, up 8%, and just a tiny 1% higher, again, virtually flatlined there, the number of sales agreed. So we at the moment, we've got this market holding its breath syndrome going on, and we need to find a way to actually counter that. So in terms of mortgage approvals, I think I mentioned this earlier on. These are the brand new numbers, the latest numbers that are out there, which are the August numbers, and you can see it fell back just very fractionally. July was 66,000. It's fallen back to 66,000 mortgage approvals for August, which puts us, to be fair, that is the 66,000 or 65,000 mortgage approvals means 1 million completions, virtually certainly 2/3 of the number, and that gets us up to the 1.2 million. But this is like looking at stars from a distance. It's a snapshot back in time. So from that point of view, we've still yet to see the effects come through of the current economic situation. And my concern is that the 1.2 million number could be under threat this year. The RICS August survey, very briefly, just a couple of slides in this. Look at this. These are the regional new buyer inquiries, with the exception of the North here and Northern Ireland, of course, where new buyer inquiries are up, and that matches prices. So those housing markets are running completely differently from the rest of the country. This essentially here is the rest of the UK going on there in terms of new buyer inquiries. And in terms of people giving instructions to sell, new vendor instructions, well, look, you can see where we are there. Quite a few properties coming on the market in London, actually. There was quite an uptick there. But generally, it's that flat picture, that market holding its breath. And if we quickly look at where the surveyors believe the market's going to go, I think this is really indicative, very, very important. In terms of the volumes, the sales expectations, for the regular viewers of the MarketCast will know that the dark mauve line here is where they think things are going to go over the next 3 months. The dotted light blue line there is where they believe prices, or where things are going to go over the next 12 months. And you can see we've got pretty much even Stevens on both counts there amongst the surveyors. They think that whether they think volumes are going to increase or decrease, they're pretty much split 50-50. And in terms of where prices are going to go up or down, and please bear in mind, these are the people that are doing your valuations. 3 months, everybody, or not everybody, the majority, the significant majority of surveyors believe that prices will come down over the next 3 months rather than go up. When you look at the 12-month picture, that just about stays balanced there. The majority just about staying positive. This absolutely reflects what we believe is going to happen too. So let's have a quick look at this then. This is what I call Rachel's rumour mill. So this is Rachel from accounts deliberately floating a few ideas of what might happen in the budget just to dip the toe in the water. What is it, the old saying, let's run this one up the flagpole and see who salutes. Well, there we go. That's Rachel. She's at it. And these are the possible things that we might see in the budget. Change in stamp duty rates. That we all know that that's a possibility. And let me tell you, if I were to show you UK volumes, it's a line that looks like that with 3 great big spikes in it over the last 10, 15 years. And all of those spikes are change in stamp duty spikes, because that's so important. Second most hated tax in the UK, by the way. The movement of stamp duty liability from buyers to sellers. I come and buy your house. It's you that has to pay the stamp duty, not me as a buyer. That is mooted as a very possible move, a highly possible move. The replacing of stamp duty altogether with some sort of property tax. And this is the classic one where they're saying, well, do away with stamp duty, so we won't make it a penalty on moving, which should boost the economy, but to replace that money. And don't forget, by the way, stamp duty raises about £14 billion a year for the Exchequer. They ain't going to be throwing that away anytime soon, and they'll be looking to pick that up How many billions they're expecting more to get out of that, I don't know, before they kill that goose that lays the golden egg. But one way of doing it is to make everyone that owns a property pay an annual tax. And they're saying that rate might come in at $500,000 value and up, or it might come in at $1 million value and up. And I think we've already seen people who are nervous about that, and that putting the brakes on the market at those levels. But it's a possibility. The removal of capital gains tax relief on your main residence, that's again very unlikely. I'm struggling to see how that would make that one work. But certainly a couple of the national newspapers picked that story up right at the start when the rumours were really flying. And then maybe the main residence actually attracting inheritance tax. Remember I said stamp duty was the second most hated tax in the UK? The first? Inheritance tax. And they're now talking about maybe that the main residence attracts that tax too. And of course, the classic old chestnut out there, a wealth tax, some sort of wealth tax. Well, I think that's probably buried in some of those too. So that's what's on the rumour bill. And you'll remember last month I showed you this seesaw. So depending on which of those things they introduce, there is this sentiment seesaw, which makes buyers feel happy or sellers feel happy. It's the classic sentiment. See, if they change the stamp duty, if they've changed the rates, everyone feels negative about that, whether you're buying or whether you're selling. If they shift the liability, for example, from buyers to sellers, well, buyers are going to feel very positive about that. Sellers are negative. Replacing stamp duty with a property tax across the piece, well, everybody then that's transacting is going to feel positive about that, because the whole country then is sharing the burden. The important point about this is it leads to uncertainty, and uncertainty is the thing that massively affects consumer confidence. Quickly on my market factor matrix as we run into the last few crucial minutes of MarketCast, and I know we're running a bit late, we started a bit late. This is how we were last October, and interestingly, I noticed that when I went back to look at last October's, I'd introduced this little budget concerns panel in here, showing the things on the matrix that were having a positive effect on the market and a negative effect, low impact and high impact. And of course, the stuff we're looking for is up here in these two quadrants, positive and negative. And I just introduced these budget concerns, and that was this time last year. Let me shift you forward 12 months here to this. This is where we are now. And look at this. So those budget concerns I've replaced with this, what I call the uncertainty index. And uncertainty is, without any doubt whatsoever, the biggest killer for the market. If people are uncertain, then they get frozen in their tracks. They get that paralysis. And also look at this, the power now up here in things that you have as developers at your disposal, but the second-hand market doesn't. Part exchange, financial devices and products, discounts less so, but certainly up here, these now are moving into a higher position than they have ever been before. So if we just race through some of the ways that you can use those tools to actually counter that budget paralysis. Well, let me give you these as 3 examples. There are more than that, but we're saving the whole set for AF Oliver clients. Sorry. For all our clients, by the way, I'll make sure the full set is in the deck the next time your account director comes to see you. These are just 3 examples. I hope you like my picture, by the way, of moving somebody from budget paralysis to winning the lottery. Well, you know what I mean. So 1, you can create certainty where it's possible. Look, fixed rate mortgages. So no matter what happens in the budget, Mrs. Miggins, we will fix your mortgage at that rate for there. And maybe even a no-lose. So in other words, a mortgage that can't get any higher, but if rates come down, we'll drop the rates. Get the IFA involved, get them creative. What about a price freeze? So post-mortgage price freeze, start using the date. You start using the date of the mortgage as a target date. Use it as a tool to encourage fast action rather than the opposite, the paralysis. I've put in here, number 2, frame this budget as a target. Give guaranteed completion dates. For anyone out there that has product that is roofed unsold, This is a golden opportunity, and this is where part exchange comes into its own. The combination of stock plots and part exchange give you a unique opportunity over the second-hand market. You can guarantee things that they can't possibly do. You wipe out all that uncertainty. That is such a powerful thing to do. And then what about this then for number 3? Offer budget-proof incentives. So whatever happens on November the 26th, it doesn't matter, because if things happen that otherwise would make you poorer or make life more difficult, then here's the incentive that says, if that's happened, we will do this. So we will hand you the certainty that you're looking for, that of course the second-hand market can't possibly do. That's just 3 brief examples of very simple things that you can introduce absolutely immediately that will take away that uncertainty and will give you a real head and shoulders shove up above the second-hand market. But you've got to move fast. So this window now, we're 8 weeks away from the budget. So this is a really do it this week sort of thing. So where do I believe things are going to go now as we run up to the end of the year and into next year? Well, this was the latest number here, of course, you'll note the dark blue blocks are the actuals. These are my forecast numbers. Funnily enough, that number, that uptick in price was exactly as I forecast. If you have a look at last month's MarketCast, that is exactly where I had it. I clearly miscalculated that wrong. Their algorithm is slightly different. I thought that would result in that number coming down here, but it actually blipped up to 2.2%. I don't understand the Nationwide algorithm any more than anyone else, including, I suspect, the team at Nationwide. Oh, only joking, obviously. I'm staying where I am with the last 3 months of the year. That is exactly where they were at the start of the year. It's exactly where they are now. I still believe we're going to end up the year, according to the Nationwide, about 1.5% higher on average, sorry about the averages, than it was last year. And that's where we're going to see the average selling price. As far as next year is concerned, well, this obviously, this could do you could do a market cast all on its own with regards to the forecast for next year. But to give you a sense of where I'm seeing it, I'm seeing very, very weak growth during the normally strong first quarter. And I'm seeing us move into a mild negative through the summer and then into a weak growth during the autumn, ending the year possibly just a point or two down or a point or two up. It's going to be that sort of year, a flat sort of year. But crucially, when it comes to the budget, if something crazy happens, then all bets are off. And obviously, the market cast that we do post-budget will be the really crucial one. So in summary then, you've got, that should say 4 weeks to wait until the budget, 8 weeks rather to wait until the budget. I forgot to lock the 4 weeks off from last month. Could be budget paralysis, but I see it as a window of opportunity for new build over second-hand. Here is one of those rare moments that you have to steal additional market share. I'm still staying with my forecast of 1.5 price inflation, and I'm staying for the long run average at about 11%, but this could improve enormously if you adopt some of those principles or marketing techniques that I was talking about towards the end of this presentation. 2026 looks set to be flat. I can't see it any different from that, but we may well change our mind after we've seen what the budget has to offer. Okay, so in terms of dates for the diary, well, we'll see. Thank you. Yeah, we'll try. There we go. So next market cast is Tuesday, 11th of November. So get that one in the diary, 2025. But it will still be pre-budget, but we'll have a really good idea of how things have gone in the interim, and we'll look at the prospects of what's coming up. But crucially, thank you. Yeah, crucially, the budget special market cast is actually going to be on Tuesday, the 9th of December. By then, not only will we have had the budget results, we will also have done some consumer research post-budget. We will know how it's making the public feel. We will know how the market is going to be aligned to deal with it. And we will set out our forecast and a few potential solutions in that budget special market cast as we run up towards Christmas. And I will find a suitably festive shirt to wear too. Sorry about the technical problems at the start. Sorry we've kept you an extra 5-10 minutes this morning. I hope you thought it was worth it. And a big thanks here to Hannah and Luke, who have worn the stress of the tech problems remarkably well, so much better than me. And I'll see you guys again in November.